So your financial planner built a retirement plan for you, and when you got to the portfolio section, you noticed that there were numbers in there like standard deviation for your investments. Maybe the planner briefly explained it, maybe they ignored it. This video is going to help you have a deeper understanding of what standard deviation is, how you apply it to your investment portfolio, and how it can help you see how your portfolio may move up and down in the years ahead. If you have a well-constructed portfolio and the standard deviation is accurate, there should not be any surprises throughout your retirement journey. But if you don't understand standard deviation, or the planner doesn't understand it and you didn't review it, then you can get into surprises in a really negative way. So watching this video is going to help give you an appreciation for volatility and what to expect for your portfolio as we move forward. Standard deviation is a measure of historical volatility for an index, an ETF, an individual stock, or a portfolio. The benefit of knowing standard deviation, in my opinion, is that you can build a range of future return scenario so that you can know how much you are likely to lose if there's a crash or a recession, as well as how much you are likely to gain under very good and very bad conditions. Typically, we would want to stress your portfolio by 2 standard deviations, and that will give us a really good idea of how much you could lose under a recessionary period or a crash. As I always say, if you know how much you can lose under bad conditions in the future, then whenever the next crash shows up, you are far more likely to stay invested. And that is very important because all financial planning software assumes that you stay invested 100% of the time. The moment that you abandon your plan and sell out of your portfolio in a market crash, your odds of success with that plan plummet. So if you want to improve the odds of success with your financial plan, you got to stay invested. Standard deviation is an excellent tool to assess your risk tolerance or your appetite for risk and how much volatility that you can expect from your portfolio. There is one issue that I want to point out with standard deviation before we get into the presentation. Because standard deviation is calculated based on historical data, the time period that you select to calculate your standard deviation is going to influence what the standard deviation is. Very important to think about that. Let me give you an example. In the last 15 years, the standard deviation for SPY, the S&P 500 proxy ETF, is about 14.6 or so. But if we look at the last century of the S&P 500 index and its predecessor index, the standard deviation is 19.6. Big discrepancy there. And the reason for that is in the last 15 years, we haven't had a lot of volatility in the S&P 500. But if we look at the last century on an annualized basis, the annual return numbers, there is more volatility in the S&P 500 because of the Great Depression in the 70s, in the early 2000s, et cetera, et cetera. The last 15 years haven't been as volatile. So now enter in the skill of you or your financial planner. When you're looking forward, you want to make sure that you're using a higher standard deviation, in my opinion, to cast a wider net, to get a more accurate assessment of range of returns. Because if you don't, you may be understating your potential range of returns based on the recent history that has not been as volatile as the longer term picture. What I'm saying is that you don't want to just blindly accept the standard deviation numbers that you see on portfolio reports or from your financial planner software program. You want to push back on that a little bit. What is the time period that was used to generate that standard deviation number? If it was recent history, then the standard deviation might be a little light. Going forward, you might want to increase the standard deviation to account for potentially more volatility in the future. If we are looking at historical data for an index like the S&P 500 or a portfolio, then we would expect that for the most part, the data is going to be normally distributed. And in that case, 95.5% of the data is going to fall between -2 standard deviations and +2 standard deviations around the mean return. Only about 5% of the time would we expect to have a return greater than +2 standard deviations or less than -2 standard deviations. In the last century, the standard deviation of annual returns for the S&P 500 has been 19.6. So let's call it 20%. And now you can use that number to gauge a range of returns going forward. Let's say that we have a mean expected return in the future of 10% for the S&P 500. If we go one standard deviation down, our total return would be -10%. If we go 2 standard deviations down, we're now at -30%. If we go +1 standard deviation, we're at +30, and +2 would be +50. So our range of returns on the S&P 500, 95% of the time, is going to be between -30 and +50. That would be our expectation. Depending on the standard deviation number that you use or the mean expected return number that you use, you might be -32 or -28, but we're going to be real close with this math that I'm showing you here. The benefit of building an accurate future range of annual returns for your portfolio is that it helps you see how much you could potentially lose under bad conditions. We already know that 95% of the time we're probably going to be between -2 and +2 standard deviations, and here's how much you can lose. So with the S&P 500, you could easily see a loss of 10, 20, even 30% in any given year. But beyond 2 standard deviations, which in this case we're looking at beyond -30, that's rare. So the best way to use standard deviation for your portfolio, my opinion, is to look at the -2 standard deviation number. Whatever that number is, are you comfortable with the loss that you see there? If the answer is no, then you need to move down to a lower standard deviation portfolio. Most people, most retirees are going to have an asset allocation portfolio, and it's going to have a standard deviation and a mean return attached to it. You can easily determine what your 2 standard deviation loss would be. And our expectation would be that 95% of the time, you will not exceed that loss. 5% of the time, you might be above or below 2 standard deviations. Very rare, might not even happen during a 30-year retirement. Remember also, we're talking about annual volatility here, 1 calendar year of returns. Here's the last 15 years of standard deviation and return data for the S&P 500 proxy SPY ETF. 14.63 standard deviation, 13.78 return. Now, if you're planning for the future and you are focused solely, for instance, on SPY, I would say you want to ratchet up your standard deviation. As I said earlier, the last century of standard deviation for annual returns for the S&P 500 and its predecessor index is 19.6, call it 20, a good bit higher than what we see here. And again, that's because of the Great Depression volatility, the 1970s, the early 2000s, etc. Last 15 years haven't been all that volatile. I would also moderate down the return. I don't think we're going to see 13.78 over the next 15 years. So if you're thinking about future range of returns for SPY, good example, or your portfolio in general, I think you need to moderate down the mean return and increase the volatility assumption, the standard deviation. Financial planning tools, software, it's not going to do that. So you need to do this yourself or have a conversation about it with your financial planner, which means you need to adjust your volatility assumption upwards. A skilled financial planner can do that for you, but a lot of financial planners are not going to be able to cut the mustard on this. Here are the 5 2+ standard deviation events for the S&P 500 and its predecessor index for the last century. There are only 5. 2008 was the most recent, -37%. 54 plus 53, 37 minus 35, 33 plus 54, 31 minus 43. These are the worst case scenarios and best case scenarios over the last 100 years for the S&P 500. Most of you watching this video are going to be using an asset allocation portfolio. So here is a future range of returns that I have developed for a number of different asset allocations: 20% SPY, 80% AGG ETFs, 30% SPY, 70% AGG, so on and so forth. With these different risk categories ranging from 2 to 8, you can see the corresponding 2 standard deviation loss or 2 standard deviation gain that I've developed with an expected return in this column for each of the asset allocations and an adjusted standard deviation. I took the 10-year standard deviation for all of these asset allocations and I bumped it up by 1% to produce what I think is a very accurate range of future returns for losses and gains. 2 standard deviations up, 2 standard deviations down for a number of different asset allocations. This is really helpful when you're doing your planning because you can pick a risk factor that feels right for you. Can you tolerate a 20% loss unexpectedly in any given year with the 70-30 portfolio? That's a risk score 7. If you can't, then you're not a 7. You're going to have to move your risk tolerance down. Keep in mind that we're only looking at annual volatility, annual range of returns here. And if you use SPY, AGG ETFs, also keep in mind that these expected returns I'm showing you here may or may not happen. And furthermore, if you use a stockbroker and pay commissions, or you use an investment advisor and you pay fees, I would expect your returns to be less than these numbers shown here. But this is a very helpful tool, this standard deviation approach, to help you decide on a risk score for your portfolio. In my opinion, not enough financial planners know how to do this, nor do they explain it properly to their clients. Now let's talk about the other shortcoming of standard deviation for risk tolerance assessment. It's called sequence of negative returns risk, and it's very real. We're looking at the year 2000 and the 3 negative years for the S&P 500, -9, -12, -22. None of these years on their own were a 2 standard deviation event. But in a daisy chain linked together, those 3 years in a sequence resulted in a serious loss for investors. So the problem with using most financial planning tools and looking at portfolios only with standard deviation for risk tolerance is that you are omitting sequence of negative returns risk. And that is a very important risk that you have to be comfortable with when building an asset allocation for your retirement. Good financial planning software will incorporate sequence of negative returns risk in the Monte Carlo forecast. That's typical. But if your financial planner is under the age of 45, they've never lived through this, and they might not appreciate it or spend enough time educating you on what happens when you get a sequence of negative returns event. You're going to lose a lot more than you're comfortable with. It doesn't take much. If you lose 10 or 15% 2 years in a row, that's a big loss. And most financial plans and portfolio selections are based on your tolerance for 1 year volatility. But again, you get a couple negative return years in a row and you're going to lose a lot more than you're comfortable with. So I think it's critical that you and your planner have a conversation about sequence of negative returns, and will you be comfortable with losses that exceed your threshold for 1 year volatility. Here's the year 2000 sequence of negative returns event. 1, 2, 3 bad years in a row, minus 49% peak to trough. It was a big loss for the S&P 500. We're looking at the S&P 500 price return for the 2000 to 2013 timeframe. Then 2008 happened. The 2008 calendar loss was only 37%, but peak to trough, it was minus 56. And here again, we have sequence of returns. The sequence was longer than a year. This drawdown lasted for more than 12 months. So when you look at annual returns, you're only going to see minus 37 for 2008, but the loss was a whole lot worse than that. So you need to incorporate sequence of negative returns into your financial planning in addition to using standard deviation as a risk assessment tool. Here's some more data that can help you on your journey. We're looking at the last 14 bear markets back to the 1929 crash, 18-month duration on average, 38% loss on average, exceeding the annual calendar losses that we would expect for, say, a 2 standard deviation move on the S&P 500. And that's because most of these periods were more than a year in length. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.